Good afternoon and happy Friday, everybody. Welcome back to Markets for Millennials for the market wrap of the week of January 18th to the 21st. And this was a 4-day trading week on the equities, although FOREX was trading on Monday for a while as well. And the only thing I have up here is my 50-day moving average in blue, my 100-day moving average in yellow, and my 200-day moving average in red. And these are just simple moving averages. They're not the exponential. I believe that the simples are a lot better, a lot more useful in terms of like the long-term trend. But we're going to spend a lot of time on the equity indices today because of obviously what's been happening. We are, and I tweeted about this. I'll show you my tweet here. I posted this on January 18th, which was Tuesday, and I've been watching this for a couple of weeks. If you've been watching this channel, you know that I've been spending a lot of time talking about the Russell and its price action that's been going sideways. But I posted this. I put currently every index is below its 50 and 100-day moving averages. The Russell is below its 200, and the NASDAQ is knocking on the door of its 200. And I wrote here, the last time they crossed the 200 SMA was the February to March 2020 crash. And well, if you just look here, again, pay attention to the reddish line here. That's the 200. S&P is below. The NASDAQ is way below. The Dow is below. And the Russell is way below. And if you want to think about the depth of these corrections, currently the S&P is just over an 8% correction from its top. The Dow is just about 7% or more, a little bit over 7% of its from its top. The NASDAQ is currently around 14% of its down from its top, and the Russell is 19% down from its prairie dog top. And so we've got the Russell just about going into bear market territory, and we actually got a death cross on the Russell, the 50-day moving average crossing the 200-day moving average. So and you can see here the moving averages are, even the 200 is sloping downward on the Russell. On the Dow, we've got the 50 and 100 starting to curve downward, and the 200 is leveling. On the NASDAQ, we've got the same thing happening, and then on the S&P, the same thing happening. So things are precarious. And just to show you what I said previously, and what I'm going to talk about here on the indices, particularly as it relates to the S&P, NASDAQ, and Dow, they're all going to be basically the same kind of analysis, but I'll get to that in just a moment. But I just want to make that clear ahead of time. So I tweeted here, back to my tweet, the last time they crossed was the 200 SMA. And I had another tweet earlier this week where I talked about what happens, like how many different places over the last 5 to 6 years where I was looking specifically at the NASDAQ, but all the places where the 50 or where price crossed the 200, and where you got a death cross of the 50 crossing the 200. And so this is obviously where it happened last time. The picture on the NASDAQ is actually really good from this period of time. If you just look here, again, paying attention to the red 200-day moving average, came, bounced off, and then broke through, right? So obviously this was, a really quick crash. Remember, this took about a month to unfold, and then it took, it wasn't long before we had actually recovered. Like if you remember in the NASDAQ, it was June when we had fully recovered and the bear market was over. Going back to the S&P, just for historical perspective, if you look at all the times that we got a considerable cross below, so obviously here in 2019, this was a big one. The Christmas Santa Claus crash in the quarter four, I should say, 2018 crash where we went down 20+%, was obviously a big place. I think before that, the next important time was in 2015 where you kind of had this double dip, right? And then obviously you come back. We had a couple of drops in the early 2010s era. And that was coming off of the heels of the crash that went from 2007 into 2009. So if you think about it, like as I zoom out, from this top in October of 2007, it wasn't until 2013 that we recovered fully all of the price losses that we had from that time. So, and that's just in our recent history. Okay, so I just want to make that clear. Like, this is a really important moment. And I mean, I'm sorry, going back, as you can see, just because we cross or touch doesn't mean that we're going to get one of those huge crashes. But it is a point of caution, right? Look at all the places where price touched the 200 moving average but didn't crash through, okay? So I don't want you to think that I'm saying that, oh, we're going to get another 20, 25, 30% crash or further, okay? I'm not saying that. But what I would say is that this zone, as you see my drawings appear again, this zone is what I call the double danger zone. And the reason why I call it the double danger zone is that it's not clear where price is going to go, right? Just like, so we have this problem that will happen where people will FOMO this to the downside. People will say, oh, we're crashing. They'll take short positions, and price, for all we know, could reverse back up. I mean, again, if you just remember what I just showed you, there were a bunch of times where price touched the 50-day or the 200-day moving average and then came back up. So on one side, the danger here is that people will FOMO to the short side and might get wrecked, okay? I'm not saying it won't go further down, but you don't know, right? So this is where technical analysis is going to come into play, and this is where it's advantageous to use not just to put my drawings back on, not just your horizontal levels, not just your trend lines and lines of repair, but also your moving averages. Okay, so what I'm going to be watching, specifically on the moving averages here, is I'm going to be watching to see if price comes down and then comes up and retouches again the 200-day moving average, or is on Monday when we resume trading, are we going to get a really big bounce back up, and are we just going to be continuing to rally? It's hard to tell. So any of those things are on the table, right? So this is why you don't want to just jump to the short side without doing your technical analysis, where you're gonna put the work in to check and see your levels where you would get that confirmation to the downside. I would be cautious here about a bounce, right? Again, being careful about a position that you take. If you were to take it to the short side, I'm not going to. I'm going to wait. I'm going to see what happens, because you want to be careful that this thing doesn't bounce. And then, of course, again, if you do take a short position, then you have to know where your levels are, where your stop losses would be. So you would want to put your stop at least above this green wick from January 12th, just above it, or above the all-time high, right? That's the only place that you know you're going to be wrong. Right? Because what a lot of people will do is they'll take a short here, put their stop loss irresponsibly at the top of this wick or at the top of this wick, but then you could get a bounce all the way up to the 50-day. And so you just have to be careful that you don't irresponsibly take positions. On the flip side, you don't want to assume that this dip is going to get bought, because obviously, as I looked back into history, you could see that there were times where it was bought, and there were times where it wasn't. Okay, so be very careful also to the long side. So this is where you get on the sidelines, and that's your position of strength, is being on the sidelines. Okay, and that would apply again to all of these indices. And excuse me, and I would be really concerned because, like, again, let me just talk again about what I was doing on the Russell. You guys know that if I turn my drawings back on, I was watching a channel right here, this white line and this yellow line. I was watching that forming for all of 2021. And I was bringing it up, why isn't the Russell coming up and following the other indices? And that's where I talked about, you have the choice. You either, the choice is either that the Russell is pausing and then it's eventually going to break out and just steamroll and outperform everything else until it catches up, or the Russell lagging is a sign that everything else is overvalued and eventually it's going to come crashing down. And up here, where this prairie dog rally happened, breaking up through my trend line, a lot of people were saying, oh, this must be the Russell catching up now to the performance of the other indices. But then obviously that got faded, came back into our zone, and then I've been tweeting for the last couple of weeks about, man, this is not looking good. Not only did we come back down into the range, but we're spending a lot of time in the bottom of the range, and then we did break down. And the Russell, I think I mentioned it just a little bit ago, the Russell is just a shade under 20%, so it's about a little over 19% down. So another percent down, I mean, if we close down 0.5% or more on Monday, that's a bear market for the Russell. And it's crazy to think like how long ago, it was just at the beginning of November that we were at a new all-time high looking to the upside on the Russell. So things can happen real quickly. And I think the danger is, maybe, I hope, a lot of people aren't lulled into assuming that, that the recovery on this is going to be just like, the March crash. That's not normal. I mean, again, look, the Russell fully recovered its level from prior to the crash in November. So that was, what is that? 8 months, 9 months? Okay. Let me go back to, I don't know why my computer's not loading here, but, it's because I'm on the Russell, I'm sorry. Let me go back to the post-Great Financial Crisis. Again, remember how long I said it took from the top, right, October 2007, it was 6 years, almost 6 whole years before we regained that level, okay? So, and if you think about it, in 2020 alone, let me do a 12-month candle just for perspective here. Oh, that's really crazy looking. Let me turn the art off for a second. 12-month candle. We just had 3 years in a row, 3 12-month candles in a row where we were plus 10% plus. Look at almost 30% in 2019, right? 16% in 2020, and that was with the crash. And then almost 27% in 2021. That is not normal, okay? That is not normal price action. If I go down to my NYA, which is obviously going, this chart goes back into the 60s, like sometimes you have these moves up, but then you also, this is also, you have to account for the fact that, off the gold standard. But, it doesn't happen all the time, right? So, just be aware of that, okay? Let me go back to my daily. Okay, so things don't look good right now. I would be careful about taking a position to the upside or to the downside. I'm staying on the sideline. I'm going to wait, actually, so let me turn my art back on for a second. So there's a couple of things that I would wait for. I'm going to look for specifically one of two things. I'm going to pay less attention to my horizontal levels here. Right here, what I'm going to be looking at on the S&P, and these principles are going to apply to all 4 of the equity indices. Okay, I'm going to be watching the 50 and the 100-day moving average. Okay, and I'm going to be watching this line of repair. Okay, so what I'm going to watch for is price going to come up and bounce and hit the 100-day or the 50-day? I'll be watching for it to hit one of those two, and that's going to be potentially the spot to start taking the short position, okay, if you're going to take it to the downside. Because if we get a rejection off those, then it's going to be like, and I'll use the NASDAQ because there's a perfect example here on the NASDAQ from the March 2020 crash of what I'm talking about here. Price comes down, breaks through, hits the 200-day moving average, bounces up, comes right up underneath the 50-day, and then we get that rejection. Okay, so that's where the short position comes in. And if you think about it, like, again, let's just think about like the percentage here. So where would you start? Okay, you would take it at the low of this green wick right here, perhaps. And then if you were to ride it all the way to the lowest closing price in the NASDAQ, that was an 18.27% move. Okay, that's a great trade. Okay, so that's why you want to wait and see what price does. All right. So for the NASDAQ specifically, what I'm going to be watching is, will it come up and touch the 200-day, right? So be very careful here. On the NASDAQ, again, you have to use your brain here. You're looking at, because it's already below its 200-day, you're going to be looking at 3 moving averages. Will it come up and bounce off the 200-day? Will it come up and bounce off of the 100-day? or will it get all the way up here and bounce off of the 50-day? Another thing to watch for is, will the 50-day come down over the next week or two and cross the 100-day? If so, that's going to be another bearish sign. All right. So again, this is just for everybody to have their bearings straight on what's happening with the equities. So that's what you want to watch on the on the equities. All right. Let's take a look at the dollar. I thought the dollar, like when I talked about this last week, the dollar was let's see, the dollar was right here on the 14th, had just come back up into the range that I was watching right here with this trend line. I can turn off my moving averages now. And I wondered, will we get follow through back into this range, or will we come back down? And I was watching, I put this yellow line here, I was watching to see if price would come back down and make a lower low. Well, it didn't. And so, but we are kind of getting squeezed in here. And so I think it's interesting with considering the price action this week. So the 18th, huge move up on the dollar, big move down on equities. That was Tuesday. Wednesday, slight move down in the dollar, equities down. Thursday, up move in the dollar, equities down. Today, move down in the dollar, equities down. So right now the dollar is not giving a clue as to what's going on in the equities. And I posted a tweet on this, excuse me, I posted a tweet on this, I think today or yesterday. I was like, okay, so are we going to get the milkshake? If you don't know, look up Brent Johnson, dollar milkshake theory. You can get an understanding of that there. I'm wondering, are we going to get another March 2020 as far as like the price action on the dollar? So look at what happened here. As we were going into the crash, the dollar came down, and then suddenly there was a huge demand for dollars, which created the spike in the dollar up into the hundreds. And then after that, with the QE that started to come in with the Fed stepping in, that was when you started to get the dollar coming down. We had that huge downtrend. Okay, so what's going to happen here? Are we going to get a sell down? Are we going to get a move up? I think obviously things are a little different because the inflation situation is a little bit different. Looking at yields, it's interesting to me to note, again, let's go back to the 2020 crash. All right, you started to see bonds roll over, the bond yields, I should say, roll over in at the end of 2019 and into January and February. So the bonds actually, the yields were actually giving it up of what was happening. Then again, we had that quick spike, and then we basically were flat because of the Fed lowering interest rates. And it didn't start coming up really until later in 2020. And then obviously we've had this consolidation, this movement sideways in this range. I've been tracking it. You guys know if you've been watching my channel. We broke out. I on Twitter and on my videos have said I don't really see it going up above 2%. That's why I put this yellow line up there, if you can see that right here. It's interesting again, like think about what's been going on here. We got huge move up in yields on Tuesday, equities down. And then for the last 3 days, yields have been coming down and equities are coming down. So I feel like that matches quite a bit of what we were seeing over here as equities were crashing, yields coming down. Okay, so it'll be very interesting to watch what's happening on yields. And to make everything even better, next week we have the FOMC meeting. I think it's next week. I believe there's a meeting in January. And so for all we know, so here's the question I'm asking: are the equity markets going to cause the Fed to step in like they did last time? They've kind of shown, based on these corrections, that when things get bad in the stock market, they're willing to step in. But with inflation as high as it is, and with the slowing economy, and with all of the scares regarding Omicron, what's the Fed going to do? Are they going to step in or are they not? And that's where the uncertainty, I think, is. Okay. Interestingly, on gold, we got a breakout from a horizontal, important horizontal level, and we've retested it, and we're closing above it. We've closed above it, so that's a positive for gold. However, as you can see, going back to our peak and then connecting to the wick here from November 16th from the most recent attempt to try to break out, we touched it, that line perfectly and got rejected. So I'm going to be watching next week to see what holds. So I tweeted about it, and I'm going to mention it again here. I think I talked about it in my video last week. I think just based on what we're seeing here, I think we're about to get our move up in gold. Now, I'm wondering if the market is preempting the Fed stepping in. So going back again, let's do this again. Going back to the March crash, right? So we had even gold at a certain point coming down and crashing. It came down, but it came down less than what everything else came down. And then in the immediate aftermath, we got the injection of QE, right? And then we had a run up, which is when gold went over $2,000, right? So I'm wondering if the market is starting to preempt and front run a crash that it's expecting the Fed to step into. Because if it does, gold and silver may have their day. But just based on the way that price here is kind of, if I turn this off, price is kind of rounding out down here and starting to gain some momentum to the upside. So I'm wondering if now is the time, right? So looking at silver, I'm actually going to be setting some orders to take some positions to the long side if this breakout holds. So I'm going to be looking for a resumption above this level. Basically, I know that's not perfect. I missed a little bit of that wick, but that's essentially going to be what I'm looking for. I want to get a resumption to the upside of that. And so I'm taking that on silver, and I'll be watching for a break above and a retest and a resumption for gold. Because I think like if the metals are going to take off, silver is going to outperform gold. So and it looks like that's going to be the case already, and that's why I think silver is breaking above some of its key levels first. But that's going to be, again, this is something to preempt. So if there's a crash, silver is going to get wrecked. But then if precious metals are in a bull market, silver is going to outperform. So you have to kind of judge what kind of volatility and what kind of performance you're willing to take in the near term if you believe in the long-term picture of gold and silver. But I'm just telling you that's something I'm looking at. Okay, and then WTI, oil. Oil is retesting this level right here. So we had this previous high, swing high on oil before this drawdown. We kind of came up and broke it. You can see I've got this trend line right here. Maybe we retest this trend line. I'll darken it up. But also just know that we've got, put a horizontal line here. We've got a level right about there that I would say has been tested now, and we're going to see if we get follow through above that level. I think just given the macro backdrop, given inflation, given the movement towards renewables and the rate at which oil wells and things are being shut down, and the way that people are just not investing in oil, I just can't see how price in oil doesn't continue to go up. Now, it doesn't mean that we won't get a pullback because of what's happening in the equity markets and all the other indices, but it's interesting to me that given what happened today in the rest of the markets, oil is up, which to me is the inflation story. Okay, so finally, sad Bitcoin. I'm at the point now where I'm basically ready to abandon my previous predictions. I'm not sure what's going on. I'm not sure why Bitcoin specifically is having the drawdowns that it's having. I would like to say that it has something to do with the equity markets. Like yesterday, when the equity markets vomited all of their gains back, Bitcoin gave everything back too. So this could be another situation like what we saw again. I keep going back to March 2020, where because of Bitcoin's current status, where we're just going to get this big puke right here, which is kind of scary to think about. Like, look at this. We had a 40% or 39% wick or candle in one day. Are we bound for that again? I hope not. But I mean, in a way, I hope not. But I also like, if we did, like, let's see if we what would happen if we got a. It's kind of scary to think about actually. But if we got a 40% wick down from here, that would put us down to approximately 21,500. That would be crazy. Well, but that would be an opportunity to get Bitcoin cheap if you believe in the use case of Bitcoin in the long term, which is something I've been tweeting about lately also, is Bitcoin's long-term prospects. Although, if you look at what I've got here, I've had this wedge. Not a really good sign right here that if you look at this wedge, we closed below the wedge and we're coming up and we're on this today's candle that we're just starting. If we don't break back into here, like we are going to go down further. The question will be how far down. Now, never before in Bitcoin's price trading history, if you go from the peak of the previous cycle to the low and use the Fibonacci extensions, we've never closed below the 1,618 golden ratio. That's what it's often been referred to as. I've talked about it on this channel. It's famous, made famous by Misconfig on Twitter. But that would be, if I were to mark that spot, that line in the sand, so to speak, that level is approximately right there. So I'm going to put that in a gold line right there. Price has never traded below that line once it broke above, or I shouldn't say traded, never closed below that line. So I am going to be looking for that to hold. So I don't think we're going to get another 40% candle down to that level that I mentioned earlier. Is it possible? Yes. Have a lot of things broken from previous cycles? Yes. So take everything that I say with a grain of salt. I, for one, was surprised that we traded below this level, because if you, let me just mark this level. This level was resistance and then resistance and then resistance and then support and support. So I was kind of surprised we traded, that we closed, not only traded, but closed below it. So anything could happen. This is where you just have to go back to your TA. So for me, once again, I'm just going to be watching this descending trend line. For those of you wondering, because I've talked about these most important trend line and crypto lines, if I just show you those, we obviously closed below an important level here. So it's not good. So everything that I've been watching has basically turned bearish. Everything that I could possibly have relied upon to say, hey, you know, things are still okay, it's not too out of hand, I'm kind of losing that there, or I've lost it. So for me, what that means is I'm not sure, and that's not comforting, and but that's the truth. However, I will say this, that it's usually at the point of at these points where people are in disbelief, where people are in the most fear. It's usually at those points where it's the best buying opportunity. And I've talked about recently that these are the opportunities that you look for, you know. And you know, I have a video about market psychology up here at this level that I just put this line at. This is the level where everyone's like, oh yeah, I'm going to wait for a dip to buy. Well, I mean, look at how far down we are. You're getting a discount on Bitcoin to buy it now if you believe in it long term. But now is the point where everyone's too afraid to buy. So again, market psychology, that's the one thing that you have to remember in the back of your mind at all times, is that market psychology is a thing. And it's true that the markets will stay irrational longer than you can stay solvent. So this is why you have to trade carefully. You have to invest carefully, and you have to be willing to endure some pain if you want to come out on top. So yeah, I'm not sure if that satisfies anybody. It probably, you know, makes a lot of people unhappy. You have to understand too that, like, I got into Bitcoin before it went on this run. I got into my GBTC and my Bitcoin positions before that run. So I'm still positive in my returns overall. But I have stop losses for where I think I'm going to be wrong. Like, it's entirely possible that Bitcoin trades down further. I do believe in the use case of Bitcoin and in the long-term fundamentals of Bitcoin. So if I were to sell anything, it would only be so that I could accumulate lower, and I would have to be convinced that I would accumulate lower. And so the only thing is now, the only problem is, you know, remember people were like, oh, this is not the low. Like, you can't say that this is the low until you make a higher high, or until you make a higher all-time high. Well, we did. So anybody who says that they knew this was going to happen is lying. They had no idea that this was going to happen. Okay. And so with that in mind, all I'm saying is tell me at what point here anybody would have been 100% convinced without a shred of doubt that we were going to come down to where we've come down. And that's where I'm saying I have levels that are far down below where I'm like, okay, that's where I'm going to be a little bit more concerned. But it's like, okay, well, where along here would you have sold to try to accumulate more? Because for all you know, we could have dipped down and then taken back off. So it's one of those things where, like nothing is certain, and that's why everything is a risk. You have to be willing to take that risk, and you have to be willing to live with that risk. Okay, that's why we always say, not financial advice, do your own research. Anyway, I'm going to leave it there for today. I think I've said enough. Again, be very, very careful. Hopefully in the week ahead, we'll have some more clarity. In the week ahead, we definitely will have clarity from the Fed about what they're going to do, how they're going to respond to this. And so we'll see what happens. So I hope you have a great weekend. I hope you can relax and get away from the charts for a little bit and really take stock of the things that matter. That's what I'm definitely going to do. And come back at it ready to work next week. I hope you guys have a great weekend, and I'll see you next time.